Welcome to This Explainer. Today, we're unpacking a massive UK tax shift affecting non-doms and a fleeting opportunity to protect your offshore wealth.
So, are you a former UK non-dom with money sitting in India? Or maybe you have historic untaxed wealth parked in another offshore account somewhere? Well, you'll want to pay close attention to this. A temporary UK tax window could allow eligible individuals to bring certain historic foreign income into the UK at just 12%.
All right, let's jump straight into Section 1, the end of non-dom and the tax shock.
When the UK abolished the non-dom regime and shifted to a residence-based model, it basically created a massive headache for historic, untaxed foreign income and gains. You see, for decades, individuals used the remittance basis to shield their offshore wealth. But suddenly, the landscape fundamentally changed. Under the standard rules, bringing that offshore money into the UK could trigger marginal income tax rates of up to 45% or up to 24% on capital gains. For a lot of former non-doms, this severe tax shock meant their offshore wealth was effectively trapped. It just became way too expensive to ever bring on shore. Moving on to Section 2, the TRF lifeline, and a 12% discount. Now, to prevent all that money from staying locked offshore permanently, the UK introduced a transitional relief. It's called the Temporary Repatriation Facility, or TRF. The government deliberately designed this as a carrot, really, to encourage people to bring their historic capital onshore to spend on UK property, businesses, and life in general. And the TRF discount is absolutely massive. We're talking about a flat 12% rate compared to that daunting 45% standard marginal rate. It's a huge reduction, essentially offering a highly attractive tax discount for a very limited time. So the really crucial point here is that this facility operates on what's called a designation model. This completely decouples the tax payment from the physical act of moving the money. Think about that for a second. You can designate the funds on your tax return and pay the 12% tax today, but you are under absolutely no obligation to physically remit those funds to the UK immediately. Here's how it practically plays out. Step 1, you identify the qualifying capital. Step 2, designate it on your tax return. Step 3, pay the flat rate. And Step 4, remit it to the UK, literally whenever you want. This could help eligible individuals fund a UK property purchase, invest in a business, or move long-held overseas wealth into the UK much more efficiently. You're securing that cheap rate today while taking your time to decide what to actually do with the cash later. Which brings us to Section 3, who and what actually qualifies. Because this incredible lifeline isn't available to everyone, it has some very specific statutory conditions. The TRF mainly benefits eligible former remittance basis users, meaning those who previously opted to keep their foreign income outside the UK tax net. To qualify, you must be a UK resident in the specific tax year you make the designation, and you must have claimed or been subject to the remittance basis in at least one tax year before April 2025. Importantly, if you have qualifying historic foreign income and gains from before the 6th of April 2025, you may be able to designate those amounts and bring them into the UK at that reduced tax rate. But if you've always paid UK tax on your worldwide income, well, this facility simply doesn't apply to you. And here is a really fantastic insider tip. You don't even need to liquidate your performing offshore investments to use this. You can actually designate non-liquid assets that were bought with historic foreign income, things like an overseas property or a piece of artwork. You just pay the TRF charge on the historic income used to purchase that asset, and then when you eventually sell it down the line, the proceeds can come into the UK tax-free. But of course, there's always a catch. Section 4. Beware the technical catch. Right, so here's the catch we need to talk about. Not every overseas bank balance qualifies. There is a deeply important distinction between capital and foreign income, and the rules are highly technical. Clean capital is money you accumulated before you even became a UK resident, which means it's already tax-free to bring into the UK. If you accidentally designate clean capital under the TRF, you're literally paying a 12% tax on money that was already tax-free. Ouch. That's exactly why mischaracterizing your funds can be incredibly costly. And this danger multiplies if your offshore account is a mixed fund, meaning it contains a blend of untaxed income and clean capital. While the TRF does have generous rules that prioritize pulling out the designated TRF cash first, you still have to rigorously calculate exactly what is in that account before you designate a single penny. Furthermore, because the TRF is a flat concessionary rate, you absolutely cannot offset it with foreign tax credits for taxes you've already paid overseas. Why does this matter? Well, if you have an offshore asset that has already been heavily taxed in another jurisdiction, you will still have to pay the full 12% or 15% TRF charge on the net amount. In some cases, running the math might actually show that the standard remittance rules with those foreign tax credits are cheaper.
Let's move to Section 5, a strictly temporary window.
This brings us to the absolute most critical aspect of the TRF, the ticking clock. The government priced this offer specifically to make people move quickly. The temporary rates are 12% in the first 2 years. That's the 2025 and 2026 tax years. After that, they jump to 15% in the third year. And then the window slams shut forever on the 5th of April 2028. There's no extension. Once this 3-year period ends, bringing historic offshore income into the UK reverts to those standard marginal rates of up to 45%. Precision is paramount here because the election is completely irrevocable once the tax return amendment deadline passes. Even if you change your mind or you decide you'll never actually remit the funds to the UK, you cannot withdraw the designation. You can't get the tax back. So before moving significant funds, review your eligibility and obtain specialist advice. We leave you with this final thought. Temporary window, permanent opportunity. Only if you plan before the deadline. The TRF is one of the most generous transitional tax reliefs we've seen, but it requires swift, calculated action. So will you secure your offshore wealth before time runs out? Thanks for tuning into this explainer, and we'll catch you next time.